the Nifty is under a bit of pressure right now.
Well, absolutely. It seems to be under some pressure. 5860 points lower. So basically, considering yesterday's close and today the open, we're down about 100 odd points, 110 odd points from the day before close. Let me just take a look at the market breadth, which is in favor of advances. So this is this is good news. Greaves Cotton, of course, we mentioned on the back of that investment in the EV arm, 10% higher. HOEC is starting about 7% in the green. So 188 on HOEC, that's Hindustan Oil Exploration. Chennai Petro had an up day yesterday. It's up another 2% right now. Should come up. And by the way, all these have got decent sized volumes. Delta Corp is up 3%. 3%, 3/3%. Renuka Sugars jumped quite a bit yesterday in the last hour. It's starting about 2.25% higher. Raymond is another one which I was talking about. It's up 2%. I mean, some of these are basically follow-on moves. So Balkrishna Industries is another one. There is JSPL, which is up about 1.33%, and so on and so forth. Interglobe Aviation is up about 1.5% as well. Sugar, I mean, it's scattered right now. Maybe it'll all come together and will move as a space. But I mentioned Renuka. There's Dhampur, which is moving higher as well right now. HDFC Life, HDFC Limited, and Hero MotoCorp are the three top losers, volume-led losers that we have on our hands. Zomato is another one which has seen a pretty large move recently from the lows. That's starting a little bit of a pullback, down 1.33% or so. Mahesh Patil is Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. He's joining us right now to take some questions. Mahesh, great to have you with us here. Thank you very much. Appreciate your time on CNBC TV18 as always. Another pullback, Mahesh, in your view? We saw a brief reprieve, but that is starting to disappear. Your thoughts near term?
Yeah, good morning. So markets, there are still some headwinds which are there. We've seen on the global front also there was a brief rally in the market after the sharp correction. And I think the headwinds in terms of inflation, rising oil prices, I mean, those are still there. And the markets are still trying to really grapple in terms of what is going to be the impact of all this in terms of growth, both GDP growth as well as earnings growth. We've seen this quarterly numbers, okay, which came in, at least on the India front, was kind of a mixed bag. We haven't seen big downgrades overall to Nifty earnings, but I think there is a potential of downgrades as we move into the in this next quarter. So I think the markets will remain a bit range bound. I think it's until the overall macro situation globally remains where it is at this point in time. And probably this market will be a market in the short term at least to sell and rise and then buy on declines, because I think on the downside also, I thought we don't think there is a big downside because especially in India, we're not seeing any major large impact on earnings growth. In the US, we've seen big downgrades to earnings for S&P in this calendar year. In India, as of now, at least we've seen around 2-3% downgrades in our own estimates. We're still looking at double-digit earnings growth in this fiscal year. So I think the P normalization, which has started after we saw the sharp rate increases globally, I think that has happened, I think, to a large extent. I think the markets are now somewhere near the fair zone, probably slightly higher than the long-term averages. So to that extent, I think there could be some normalization which could still play out in the coming months.
Okay, fair enough. By the way, just pull out HDFC Life. There's a decent-sized block deal which happened first thing in the morning at 600 rupees, almost a 90 crore block. And if you see the chart of the stock, it's seen a bit of a downtake, 2% lower. Mahesh, good morning. The big debate now is on IT because that's been the leadership sector for the market for the last 3 years. And there are now, a lot of downgrades, but a couple of upgrades also happening now. Your thoughts on this space?
IT sector, again, has come down on the back of global IT stocks, NASDAQ, especially a sharp correction in the NASDAQ. So we've seen, again, here, the bigger change has been in the P multiples, okay, which have got corrected. I don't think there is much downgrades to earnings, what we see. We saw small downgrades after the fourth quarter numbers. But again, talking to some of the large IT companies, we're still not seeing the fear which is there. I mean, people who are negative on the IT sector fear that because of the US slowdown or recession, you would see overall growth in the IT sector, which is currently in the mid-teens, to come down. But at least for the next 2 years, the visibility in terms of order inflow and pipeline is still fairly strong. I think the spend which is currently happening in the IT sector at this point in time is more towards growing the business, is more on the front end, cloud migration, and that spend is not likely to really slow down because a lot of global companies are still to really catch up with their total digital spends. So in that sense, I think the outlook looks fairly stable. Margin pressures, okay, which have been there, but I think the IT companies are now trying to recruit at the bottom of the pyramid and trying to manage that, especially the large IT companies. And I think rupee depreciation, I think there is still some room for rupee to depreciate is what we feel. So that should help to mitigate that. So we don't see any major downgrades to earnings to IT sector, and the valuations there look fairly reasonable now. Okay, they're still expensive compared to long-term average, but considering the fact that these companies generate good free cash flows and the free cash flow is good, I think this should probably be a more stable sector in the current environment.
Okay, just look at the IT sector right now. Massive move is what you're seeing. In fact, this is how tough the market is. Yesterday it was a complete reverse. The day before was reverse of that. And now if you see the IT index is up 1.2%, primarily led by TCS. See the intraday chart of TCS. That stock is moving higher and is helping the Nifty. The Bank Nifty is down still, but IT Sonia is helping the Nifty pull back a bit.
Okay, yes. But, you know, I mean, since you're talking about the upside, let me talk about the downside, right? The biggest loser in trade this morning is Hero MotoCorp. That stock is now down almost 3%. Mahesh, hi, good morning. You know, one trend that we notice is that the two-wheeler space is just not coming back. I mean, Hero MotoCorp, Bajaj Auto, compared to May of 2019, which was a normal year, these company sales are down 25-30%. At any point, does it become a buy or do you strictly stay away?
Right, and the two-wheeler sector has seen, even pre-COVID, okay, it was slightly going, the volumes were down because of the transition to Euro 6 norms. And then we've seen the steepest price increases in the two-wheelers, and price increases overall in the last 2.5 years will be the extent of around 35% or so. So that is what I think is impacting the sector and really come back to the earlier peak levels. I think it will be a slow and gradual recovery over there. The rural economy, I mean, a lot of two-wheelers are actually, it's a highly penetrated market already. And rural economy is where the larger incremental growth has been. And as you know, last year, the rural economy got impacted and there was a serious slowdown over there. So that's the effect what we're seeing. But I think the only hope in this sector would be if the rural economy comes back, and there is some silver lining over there because this year we are seeing that the farm prices are very good. I mean, all wheat prices, cotton prices are strong. So, and the outlook for rainfall is also fairly normal. So if the farm incomes are good, then we could see a revival in the rural economy, and that should really lift the volumes in the second half is what the positives could be. The sector looks fairly attractive at this level in terms of valuations. The margin pressures also, which were there on the raw material side, that should also ease off a bit because now the metal prices are starting to correct. So all in all, I would say looks fairly decent, I think, but the pickup in volumes should be slow and gradual.
Pickup in volumes will be slow and gradual. Mahesh, any thoughts on the hospitality space? I mean, hotels in particular. Do you have a strong view here? Do you own any names? I mean, there aren't that many, but in terms of large chains, but we've got a couple. Go on.
This sector has actually done fairly well, and post the lifting of the lockdowns and in the last 3-4 months, we've seen a good buoyancy in the whole hospitality space, especially in the hotel side. There has been an increase in occupancy, the increase in the overall ARRs. And for the first time, actually, we are seeing very strong demand outlook and profitability in the sector improving significantly. So the sector looks good. I mean, we were always slightly negative on the sector earlier, but I think the outlook over here now looks good, and not many really names there. But I think the overall industry is also now trying to move here from an asset-heavy model to asset-light model, and that was one of the reasons why we were not so positive. But I think most of the large companies are now looking at an asset-light model, which should improve the overall cash flows, and that's what could really make the sector look more exciting going forward.
Okay, we have a discussion lined up in just a while from now on the real estate space. And, you know, real estate companies, real estate proxies have done very well. This home improvement theme has picked up quite a bit. In that space, do you, as an asset class, how are you looking at it? I mean, is it still the best thing to perhaps buy a property rather than buy real estate stocks, or would you look at it otherwise?
Real estate had seen, again, last year was a very good year for the industry. We saw a good increase in overall absorption. The volumes were good. And again, it was aided to some extent in terms of the pent-up demand and also the SOPs which are given by the state governments in terms of waiver of the stamp duty. Increment and again, the low interest rates were also another positive. I think some of these things are turning a bit, not negative, I would say, but at the margin a bit adverse. We've seen interest rates now, mortgage rates going up a bit, and, and property prices have started to move up a bit. So while the sector still looks fairly good, but I think the high volume growth what we saw last year, I think that is kind of slightly slowing down. But the good thing is that the inventory which was there in the system, that has come down dramatically. The new launches are now starting to come up, and the new developers are now catering the ticket sizes in terms of actual where the demand is. So I think the sector should do fairly. I think we have come out of a long down cycle in the last 7 years, and there is still more room for the sector to do well over the next few years. So we are selectively stock-specific companies with good balance sheets and good execution track records are the companies which one should be looking at in this sector.
Okay, by the way, the market's making a move back in the green, almost on the Nifty now. Sensex in green, mid-cap index in green. The bank Nifty is still down, but the Nifty is also almost in the green. The top loser now, though, is Apollo Hospitals, and it's been a rather rough last 3 or 4 months for Apollo Hospitals. And ever since its index inclusion, it's seen just a one-way move. Mahesh, and it's across the board, right? The healthcare space, whether you want to include hospitals in it, the pure pharmaceutical play, diagnostic stocks, all of them have seen fair bit of derating, down about 35 to 50%. What's happening here?
I think, I mean, if you look at most of the sectors where which had become very expensive, and there has been a significant PE re-rating in the last 2 years, especially during the COVID times, I think we have seen a normalization of multiples over. That is the first thing I think what we are seeing. Now the sector multiples have all gone up almost 50, 60, or even doubled in the last 2 years compared to the historical averages. Also, I think the competitive intensity in, say, especially in the diagnostic space, is likely to increase. That's what the fear is. And also the base was very high last year because of COVID. There was a kind of buoyancy in terms of revenue growth, especially for the diagnostic companies. So that, I think it is coming up from a higher base. So the earnings growth in this year is not looking all that great. And the high valuations have corrected. And that's the, otherwise, I don't see any major structural change in this sector. The sector still looks fairly good from a long-term perspective.
Okay, all right, Mahesh, appreciate your thoughts. Thanks a lot for joining us. And the discussion that we were just having on the real estate sector, we're going to take that forward.